So I think in the digital marketing space, that's where we're going to see the impact, because smart owners are utilizing AI for greater efficiencies across the board. And that provides better EBITDA and therefore a higher valuation.
Welcome to the Agency Profit Podcast, a show dedicated to going deep space on agency operations, which is just as nerdy as it sounds. I'm your host, Marcel. I'm the CEO of Parakeeto, a firm that helps digital and creative agencies measure and improve their profitability. Join me as I interview some of the smartest thought leaders and agency owners in our space and go deep into operations, metrics, and all the other things you need to get right so you can spend less time worrying about operations and more time executing on your vision. Hello, everyone, and welcome back to the Agency Profit Podcast. I'm pleased today to be joined by an M&A expert who's been working in the industry for a number of years, built and sold his own company, and now helps agencies in particular find transactions that not only help them get liquidity, but also help them evolve their practice and take a big step forward in their career. He talks about it and calls it a second bite transaction. So really interested to dig into all of this. And with that, Todd Taskey, thank you for joining us today.
I am very excited, long-time listener and watcher of the pod. So happy to finally have made it here.
It's a pleasure to have you. We were introduced by a mutual friend who spoke very highly of you and your expertise. And so I'm really excited to dig into this topic. I really do love M&A. It fascinates me. I love talking about it. So really excited. Now, before we dive in, I'd love to give you a chance to, in your own words, describe what you do and who you serve.
Yeah, thank you. So we do investment banking transactions. We do them in the digital marketing space. Clients are usually between 1 to 5-ish million of EBITDA. And most of our clients are interested more in accelerating through a transaction as opposed to exiting through a transaction. They love the idea of getting real cash at close, right? Some liquidity for all the hard work and effort that they put in. But the focus is on doing something bigger, making a bigger impact, going faster, on and on from that standpoint.
Mm-hmm. Awesome. And you do this as part of Tower Partners. And
Yes.
When you talk about, investment banking and investment banking transactions, for those that maybe have never heard of investment banking, maybe aren't familiar with M&A, could you maybe briefly describe what that means and what part of the scope of, helping somebody go to market and exit their business you handle?
Yeah, I guess best way to put it is from beginning to end, right? From thinking through the opportunities to finding interested parties to working it all the way through until you're a member of a new organization with a bunch of zeros in your bank account.
Mm-hmm. So you talked a little bit about your thesis here, which is helping these kinds of businesses at this particular stage of growth, 1 to 5 million in EBITDA, to have an evolutionary transaction. I've heard you refer to it in the past as second bite transactions. So let's start with, talking about M&A in the context of it being a quantum leap or a big step forward strategically, because I think a lot of people think of having a transaction as sort of the end of the road, whereas I think in your framing, it's very much the beginning of a new chapter and can be seen as more of a step along the longer journey. So talk a little bit about why M&A can also be looked at through this lens of a continuation of the business rather than the end of an owner's sort of tenure as the owner.
Yeah, happy to do it. So I think examples are always the best way to illustrate. So, for example, we did a transaction earlier. My client was had an Amazon agency, and they finished last year about $1.1 million of EBITDA, and by January had already sold enough work that they would do $2 million of EBITDA this year. And I said, "Geez, man, that sounds terrific." He said, "It is terrific, except somewhere in the third quarter, man, all the wheels are going to come off because I don't have the infrastructure, I don't have the people, I don't have on and on." And most importantly, I don't want to build an agency. I don't want to worry about utilization rates and client satisfaction and NPS scores. You know what I want to worry about? Getting good results on Amazon. And so we did a wonderful transaction for them, sold them into a group. My guy got cash, a good chunk of cash at close. He got equity in the mothership, as we like to call it. It's got a little bit of earnout. The fit has been so strong for him that he's already realized he reached the milestones to get his full earnout. So that's terrific. And in that transaction, he's a part of an overall solution to the client, for the client, right? We've got others that want to build an agency in their own image and likeness. And as an example, we had a client, gosh, this is Thanksgiving week of 2019. And they were 2 million of EBITDA on about 10 million of revenue. Really good business, a diversified offering. They were probably 60% earned, 30% paid, and maybe 10% email. We sold them to a private equity group in Boston. Our guys got roughly 8-ish million in cash. They've got 1 million in earnout, which they got, and they kept roughly 40% of the business. Fast forward to the end of 24, so 5 years later, there's 16 million of EBITDA. And I would guess a business of that size with their retention and metrics and all the rest probably trades for 13 or 14 or 15 times EBITDA. So it's 210, $220 million. They've got about 30 million of debt because they've done 4 acquisitions. And my guys from those acquisitions have been diluted down to roughly 24, 25%. Or said the other way, 5 years ago, they sold 60% of their business for $9 million. And the 40% they didn't sell, I think it's worth 40 something million dollars. And I think very importantly, they've had more fun over the last 5 years than they had in the prior 15 or 20. They're doing bigger things. They've acquired really good businesses. They love their private equity partner, on and on from that standpoint. So they built that business and grew that business with the support of private equity, where the other guys are playing a part of a fuller role. A year ago, we sold a great business that does conversion rate optimization. And as everybody knows, that's just one sliver of an overall e-commerce solution. And so he's part of the larger solution, and that's been a great transaction for him.
So this makes perfect sense, right? And I'm reading between the lines a little bit, but it sounds like the people who are the best fit for this kind of a transaction are at a point in their career where they don't necessarily want to stop working, but maybe they're prepared to no longer be the sole owner of the business, or they recognize that there's a gap in skill set, in resources, in market access. There's maybe a strategic opportunity to bolt onto a larger platform that can get them to where they want to get to and get their business to where they want to get to faster. And it sounds like private equity is often going to be the kind of buyer of a firm to execute that strategy. But are there other kinds of buyers that you're working with as part of these kinds of transactions?
Yeah, yes is the answer. Oftentimes those other buyers, known as strategics, are owned by private equity, which is great because private equity has a checkbook. They have a predetermined mindset that they'll add value by and through acquisition. And, they facilitate transactions pretty well. So from that perspective, as private equity continues to play a larger role in many industries, the digital marketing space is certainly one of those.
Yeah. So I want to address the elephant in the room, which is I think a lot of people hear the word private equity and think about the idea of selling their firm to private equity, and it comes with some negative connotations or some negative beliefs that they're going to basically strip the business for parts. People get laid off. That they're total sharks. That you're going to get taken for a ride. You'll have these terms that require you to hit all these milestones that are impossible. It'll be gamed, and certainly there are probably some examples of that. But I think you're starting to point to a whole bunch of reasons why private equity actually doesn't have to look that way and can be really accretive to the business. So, how do you address some of those negative beliefs and why should people consider selling to private equity if they're thinking about a transaction that moves the business forward like this?
Yeah, that's a great question. I think a lot of times the stories that we read are big transactions. A $500 million business, a company doing $100 million in EBITDA. Well, if I buy $100 million of EBITDA business and I can trim 8%, 6%, that's real money, right? If I buy a $2 million EBITDA business, it is a growth story, not what they would call a financial engineering story. So in the size range that we deal in, typically they're going to grow a business, call it from 2 to 20 million of EBITDA. That means we need more good people, not fewer good people. That's number one. Number two, there's a couple of, many basic things when you're selecting a good private equity partner. People get confused about the options that are out there. There's fundless sponsors, there's search funders, there's private equity, there's real private equity. So it'd be helpful to get some advice from that perspective. But I will tell you one thing that I see as a mistake often. Our clients get a vast majority, if not all, of their earnout almost all the time. And I'll tell you how we win on that. We win on that when we put the deck together. So to use an example, I'll use the example from earlier. Our clients, 2 million of EBITDA. They've been growing 15% a year, right? That's 2.3 next year. Nobody believes they're going to do 2.3, and I certainly don't believe they're going to do 2.5 million. But for some reason, when people put their decks together, they want to show accelerating sales and bigger numbers. And then when you finally get to an offer, and a component of that offer is the earnout, the question is, well, what do we got to do to get the earnout? And the buyer says, I don't know, we just want the company you showed us. What did you put in there for growth? And now all of a sudden they're looking at 30% growth, like, holy shit, we can't do 30% growth, right? So even if I've got a client that's been doing 30% a year for the last 3 years, we put 10% growth in for next year. And then the buyer will eventually say, well, wait a second, you've been doing 30% a year. How come you're at 10? And the client every time says, I'll tell you why. We project 10% growth every year. And then we work really hard to outperform that. We're a $12 million, $15 million business. We don't spend time worrying about fictitious numbers that might arise in the future, right? Our goal is 10% growth every year, and that's what we're going to set out to do. And so when you set those expectations about what the deal's going to look like, then and that's really the source of consternation, if you will. And then if there's one other, private equity, in my experience, private equity wins all the time. A, they're smart. B, they recruit good people. C, they got money. And so when you put those things together, the only thing they need is a good entrepreneur to help them grow a business. They also need to sell your business probably to another private equity group in 3 or 5 or 7 years. That private equity group, I know what they're looking for from a financial perspective. It needs to be GAAP, needs to be accrued for properly, needs to have all your ticks and ties that match up. That's what that rigor and discipline they're going to impose on your business, because that's going to be projected into the future. Guys don't like that, right? We haven't been doing it like that. We've been kind of making it up a little bit. And, we've got a deal closing Friday. They haven't been paying their state sales tax in Arizona and Connecticut. To which my client responded, what are you talking about? We don't owe sales taxes there. Well, when we did the Q of E, turns out you haven't ever paid them. So the liability literally is $180,000. And so we are now going to put $180,000. The statute of limitations is 2 more years. If they don't come asking for it in 2 years, we get the $180,000, right? If they do, then, that's going to go out to them. So sometimes I think that there's interpretation that private equity is just screwing us because of all these things. But, private equity has a pretty good target on their back, right? People will respond differently to private equity than a small digital marketing agency that they don't think has any money. That was a really long-winded answer, but I could ramble more and more on that.
It's a good answer. And it starts to get into the next thing that I want to talk about, which is, I think people don't understand the business of private equity. And I think it's worth talking a little bit like, what is their business model? How do they make money? And what motivates them? What are their incentives when they go into a deal? Because I think that starts to explain how they operate and what you might experience and what you might expect when you start working with a private equity firm. And of course, they all have different cultures, but like by and large, that business model is fairly standard and straightforward in that like a lot of them are buying a certain amount of EBITDA, trying to grow that EBITDA, and then trying to sell it at a higher multiple based on a whole bunch of financial sort of engineering strategies that just make sense. So yeah, explain just a little bit like what is the business model of private equity and what makes them tick?
Sure. So a couple of things, if I may. We host a podcast. It's called the Second Bite Podcast. So if any of your listeners, rather than hear me go on here, want to listen to other founders that have been through transactions, secondbitepodcast.com. On the Second Bite Podcast, I think it was last summer, maybe it was this, we did the PE Insight series. And I asked one question and had 7 or 8 private equity guys answer that question. And we did 5 or 6 questions in different episodes. So if you just go there and you search PE Insights, you can actually hear from private equity guys, right? What do they look for in a target? What do they want to see in a deck? How do they think about transactions? How do they negotiate, on and on from that standpoint? But the way private equity works in a nutshell, and this is a great question that your audience should ask when they're talking to somebody. Do you have a committed capital fund? Meaning, have you raised money? And many of the best funds in the digital marketing space, the answer is yes. And they'll have 200 or 300 or 500 million dollars. And then what they will do is look for a business in the digital marketing space or whatever the vertical is that they're interested in, so that they can take that business and grow it from on the podcast. One of our guests was Grayson LaFrance. He was the founder of Power Digital. 2-part episode. It was great. They had 4 owners, this going back a few years. 4 owners, about 5 million of EBITDA. They did a transaction with Periscope Equity, a private equity group in Chicago. It took them 3 years, and they grew that business from 5 to 30 million of EBITDA. They sold it to a larger private equity group called Court Square. And the private equity group, the founders, and the first tuck-in acquisitions they did got 13x on money in 3 years. So let's just say it took them 20 million of equity into that business. And I don't know what the capital stack was, but let's say they put in 20 million of equity and they borrowed 15 million of debt, and they got their percentage of ownership, which is usually over 50%. When they sell that business, if they got 13x on 20 million bucks, that's pretty good, right? And the partners do well and the firm does well, and on and on. They also get a management fee for the money that they have in their fund when they invest that. And this is one of the things, again, at larger funds. If you think about a $2 billion fund that takes a 2% management fee, which is fairly industry standard, 1.5% to 2%, that's $40 million. That's pretty good, right? To manage assets and to continue to grow and to continue to profit and on from that standpoint. So from that perspective, some might be a little bit more aggressive. So they will invest out of their fund and have 8 or 10 or however many platform companies. They'll tuck in other companies to grow that business. And then they'll manage that so that they're exiting some businesses that will show a good return. So now that we're wrapping up Fund 2, we can go out and raise fund 4, maybe fund 5, depending on where the others are in the stage that they're all in. And in a nutshell, that's their business. If you look at some of the great funds, Periscope Equity, Keystone Equity, Mountain Gate, Trinity Hunt, these guys in the digital marketing space have repeatedly had big successes and big exits in the digital marketing space. And if you could get your money, your equity next to theirs, I think the question becomes, how many multiples do I get on my money, as opposed to, is this going to turn into something? And that's the part that gets people excited. If I could be with a group like that that's done it multiple times, if I could take some chips off the table, but now I can get all of these additional resources to help me grow, and not just money, but I mean, other smart people. We're focused on conversion rate. I want to talk to somebody that does paid social. We need to have a robust sales team. When we sold that CRO business, Ned, who's also on the podcast, Ned McPherson, Ned's a roughly $8 million agency in Miami. They sell CRO services to large D2C brands, and they do tremendous CRO work. As Ned would tell you, it takes me forever to get in front of somebody, the decision maker. Well, I get in front of them, I sell them every time. Power Digital was the buyer. Power has 220 e-commerce customers. Every single one of them attached to a salesperson. Every single one of them selling Ned's capability set. It's been fantastic since they did that.
Do you want some free resources to help you measure and improve your profitability? If you do, then I want to tell you about our agency profitability toolkit, which you can grab absolutely free in the show notes or by heading to parakeeto.com/toolkit. It's packed with training videos, cheat sheets, templates, and all kinds of other great resources to help you start measuring and improving the essential metrics that are going to drive better profitability in your business. And it's helped thousands of other agencies around the world do the same. So I want to encourage you to go and grab a copy of that. And if you'd rather get in the fast lane and just have our team of experts guide you through the process of measuring and improving your profitability, then I want to encourage you to apply for a consultation at parakeeto.com. And with that, I want to thank you again for tuning in. I hope you enjoy the episode, and I'll let you get back to it. So you're getting into, I think, something that's important to talk about, which is like, what is the value that private equity brings? And, why are they getting these kinds of results? And one way that I've started to frame a private equity firm is like, it's like a management consulting firm, but they're so confident in their capabilities that they're playing with their own money, or they have had other people give them money to say, like, go deploy this because we trust your capabilities that much, right? So, I have a friend that just sold his SaaS company to a private equity firm, and he has been blown away by the competency of the team that he's now working with. And he's like, he spent 20 years building the SaaS company, sold it for multiple 9 figures. And he's like, I've learned more in this last 6 months working with this private equity firm than I've learned in the last decade building my business as a solo founder, because of how advanced this management team is. Like, they really know what they're doing. And I think that if you're a founder that runs an agency and you don't feel like, hey, I'm a world-class agency executive, I don't understand this business model like at a world-class level, but I feel like I need that skill set. I think that's a pretty compelling argument for why this kind of a transaction could actually make a lot of sense, because that's what they bring to the table. And I think part of the reason that they're able to repeatably get these kinds of results.
That's spot on, number one. A couple of years ago, we were doing management presentations, and the buyers came to town, and they're usually like 3-ish hour meetings. And we started in this one buyer group, pulled out their deck of my client and started going through. We got to the place about cohort analysis. You're familiar with this, cohort analysis? And my client said, listen, can we just take a break for a second? And he asked me to step outside, and he was furious. He said, where did they get all of this data from? Why would you give them all this information? I'm like, dude, I gave them, they got the standard package. This is the level, this is the next level these guys play at, right? every single group does a cohort analysis. They all do it, right? You haven't even begun to talk about retention yet. And he was, like you said, blown away at the level of analysis that they do. I say great deals are art and science, great second bite deals. The science is this: cohort analysis, retention analysis, regression, blah, blah, on and on and on. Then it's your multiple plus the add backs times the, and on from there. And the art is getting the people right and making sure there's a good fit and on from that standpoint. So they are a bunch of very bright people that, like for any of your listeners, they've all done great work for a client. I'll make it up, doing SEO for them. And they get better and better and better and know how to do it really, really well. So when a person comes in the middle of their sweet spot, they're like, I know how to do that. And this will be great. And they deliver great results. Private equity is the same thing, right? They look at a business doing two-ish. They see what the sales function is like. They see what the accounting function is like. They see the way that some of their processes work or don't work, what utilization rates are. And they know that over time, we'll fix all of these things. Some of them will interject on, some of them will acquire another business that has a better sales methodology or does better paid social or whatever the case may be, and we'll put all the pieces together. That's why they win. Plus, even if they're struggling or stumbling, there's enough money to buy themselves out of a bad situation, so they don't ever really lose. The question becomes, how big do they win or not?
So we're getting into the next thing that I think is important to talk about, which is this point of these are professional acquirers of businesses, and they do it en masse. And for, I think, a lot of people listening, they'll probably have never gone through a transaction, or if they have, we're talking single digit number of transactions relative to tens or hundreds or thousands of transactions on the PE firm side. And so there is a massive imbalance of experience. And in some ways, that's a good thing because the private equity firm knows what they're doing. But in some cases, they might use that to their advantage. They are, after all, incentivized to get the best possible price on the assets that they're buying. So what are some of the things that people should be watching out for, or some traps to avoid when you do start entertaining conversations with private equity?
Yeah, so I'll answer a couple things there first. Number one, on private equity. If your business is 2 million of EBITDA, let's say you can get 6 times on that, maybe 7 times on that. If you're 20 million of EBITDA, that business is 15, 16 times, right? So that's one of the ways it's known as multiple expansion, that the multiple becomes larger and larger by them putting the pieces together. Said in an overly simplistic way, if you buy a bunch of $2 million businesses and you pay 6 or 7, and then you can sell the whole thing for 15 times, you're going to make a lot of money doing that, right? So that part is very helpful from a private equity perspective as they put the pieces together. There's just less product available, meaning there's great private equity firms that manage $1 billion or $2 billion. Then they have to put their money to work. They can't buy a $5 or a $10 million EBITDA business. It's just too small, right? It doesn't make enough impact. So from that perspective, that certainly helps. When you go through a process and you talk to multiple buyers, that's the best way to get what we would call true price discovery. Somebody knocks on your door and offers you, you're again at 2 million, offers you 12 million. I don't know how to think about that, right? Is that good? Is it not good? I mean, there's always questions: how much cash, how much stock, how much this and this, right? But I don't know if that's a good number or not a good number. And so what guys do is they compare it to a story that a buddy of theirs told them 2 years ago, or an article that they read somewhere that they have no idea about, right? If I had 4 offers, one of them was at 12 and the others were at 9 and 10 million, geez, 12's fantastic now. right? If all the others are at 15 or 16 million, 12 is not worthy. So it's hard to know what's best from a value perspective if you only have one offer. It really is. So from that standpoint, that's probably the best way to know for sure where your offer is to have more than one offer. And by creating that competitive tension is how you find out where the full value of the business is.
Yeah. So to dovetail on that, one of the, I think, important components here is understanding, like leading up to a transaction, understanding what these firms are going to value and what they don't. Because I think there's a lot of decision making about, we might make some investments in the business or we might use some cash to try and shore some things up. And then you might end up in a situation where it's like, we just went through the process of getting onto a whole new CRM. And the PE firm doesn't care about that at all because they're ripping it out anyway. So,
right, and they're going to put it on theirs.
Exactly. Yeah. So what are some of the gotchas, some places where, you would place a little bit less emphasis relative to the standard rubric of like, here's all the boxes you need to check to sell your business in more of a generic context?
Yeah, I'll tell you how I think about it. And I think about it a little bit differently. And again, I've been doing this for 20 years and we've gotten a lot of feedback. When you go through a process, you're going to talk to 20 or 30 really smart people that know your space very well, that own a checkbook and don't really care about your feelings. As you go through these conversations, you're going to hear the same themes over and over and over again because the same smart people are going to see the same things, strengths and weaknesses. And they're going to come back to you and say, listen, the things we don't like about the business, which forms our thoughts around the value. You guys, you do too much of this and you're not doing enough of that. And then there's the other thing, right? So there's this, that, and the other thing. So if you go through this process and you and your partner look at each other and say this, that, and the other thing, to improve the value of our company, this, that, and the other thing, man, it is laid out for us over and over and over again from really smart people. This is the value of the entire process. This, that, and the other thing. And so what I tell people is the only reason you won't sell is because you didn't get the right value for the business. And we're pretty good about understanding the value based on, we swim in a pretty small pond. The reason you won't get what you want is because of this, that, and the other thing. Now you get a choice. For the next year, 2, 3, whatever it is, you and your partner work on this, that, and the other thing. And your company will be more valuable. Or you will look at each other and say, my God, this, that, and the other thing, do you have any idea how heavy of a lift that is? To get this much more? I don't think it's worth it. But now you're making a very informed decision about the future of our business and all of the reasons why. And so when you go through that process, there's a couple people, sorry to keep referring to the podcast, but I've had a couple people on the podcast that we did not close transactions with. And they said, Todd, this was the greatest experience I ever went through. My business is already getting dramatically better, right? And then as it relates to the particulars, you can add back many things in the business. You certainly add back to your EBITDA all of the owner compensation things that will stop at close. One-time expenses, like the CRM expense, for example, you're not going to have that every year. We could probably get part of that added back. There's a whole bunch of different things you can fight for that will potentially have a nice impact. And that's again, we go back to the science. It's multiple times your EBITDA equals. The only thing I care about is the equals, right? So I don't care what because we can move both of those factors. So if we can add a little bit more to the EBITDA number because we couldn't get the multiple up high enough, maybe that still gets us a bigger equals.
So it's funny. I've had some friends that went through a process, didn't sell, say the same thing. Like, I basically got a lot of really good free consulting through that process. You know, the investment was their time, but they said kind of the same thing. Like, it was a really good learning experience. So it's an interesting take. The last question I want to close on, I could talk to you for hours, Todd, but I got to keep it to one last question, which is where you see things going. Obviously, the industry has gone through a lot of change and is going through a lot of change. The pandemic changed a lot of things as far as global competition, the labor market, remote work, labor arbitrage, and now you have AI entering the chat and shaking things up. How have you seen this impact the M&A market, the thesis that private equity firms are going to market with, and who do you think is poised to exit within the next 12 to 24 months based on that context?
That's again an insightful question. So I always say this, you are what your revenue says you are. So if your revenue is agency revenue, if it's paid, if it's SEO, whatever, that's what you are. You may have AI infused in your business. You better have AI infused in your business, but that's what you are. And agencies trade at a multiple of EBITDA. The influence to that is going to be your retention and how much is recurring. Are you going to get a premium because of AI? Here's how you will. As everybody listening knows, you gain greater efficiencies using AI. You can probably stack more clients on the same amount of employees. And if in fact that's true, after your initial investment, your margins will go up. Better margins means on the same revenue base, you have better EBITDA. And that better EBITDA will translate into a greater enterprise value. So I think in the digital marketing space, that's where we're going to see the impact, because smart owners are utilizing AI for greater efficiencies across the board. And that provides better EBITDA and therefore a higher valuation.
So there was another question I want to ask you, and we are going to have time for it. And I think it's perfectly relevant to this, which is like, you know, understanding the thesis that the PE firm has for acquiring the business. And, you know, I've heard from some friends that have gone through this, this process where, you know, they might throw something at you of like, oh, you know, we don't think that you're worth that much because of this thing. But they understood the strategy well enough to say, you don't care about that. That's not even why you're buying the business. You're buying the business because our technology can get plugged into your $100 million machine and make you an extra 12% next year. Therefore, like, we shouldn't even be talking about the EBITDA of our business. And so my sense is that AI is creating a lot of those situations where you have a PE firm that maybe is building a platform out of a company that has like really cracked something with AI. And therefore every tuck-in is like a massive upside because they've got some edge. Or maybe they're evaluating a small tuck-in that's not really that interesting from a financial perspective, but has a technology that massively increases the enterprise value of their portfolio. And so it sounds like, or my thesis is that there's probably a lot more of this like highly strategic stuff going on that's a step above just like traditional, multiple arbitrage, if you will.
I think in the tech space, you're absolutely correct. I think in the company size we're talking about, oftentimes what impacts the value and the opportunity inside of your business is being evaluated outside of your business in a conference room somewhere else. Because that conference room, they have decided we need better CRO. We need paid social. We need to improve our Amazon capabilities, whatever it might be. Here's the thing though. So for an Amazon shop, and I know you know lots of folks in the space, there's not one Amazon shop. There's plenty of them, right? Maybe they're limited, but there's lots of them. Do I have to pay 10x for a $1 million EBITDA business? No. I'll go to the next one. Yours is great. Yours is my first choice. I'm not going to pay twice the market for it. So in a services business where there's multiple people providing those services, it's hard to get an outsized return because of something you're doing. Exactly to your point, though, for opportunities created outside, like the people at Power Digital when they wanted to buy CRO capability, like the people at Acadia that really needed to get and land this Amazon agency. There's reasons, and they both paid, I'm going to call it high end of the range. Maybe it was even a little higher than the high end of the range because it was a perfect fit. They could move quick. They liked the people. It all fit on and on from that standpoint. That's what you get with the services business, though, right? You're not the only guy doing it. Your AI technology is not the only. There's no agency out there that's going to create AI, right? And if you do, you're certainly not going to keep up with the spend going forward. So you're going to use and modify something off the shelf that makes your business fantastic. That's great. You want to get paid for it? Turn that capability into bigger EBITDA. A bigger EBITDA margin is going to get you a bigger enterprise value. That's where nobody will necessarily argue with you up to a certain point.
Mm-hmm. I wish we had another hour to chat, Todd, but unfortunately we're both busy people and you've got places to be. So for those that want to learn more about you and what you're doing, where should we send them in the show notes?
You can catch me at Todd at Tower Partners if you want to reach out. I'm pretty easy to find on LinkedIn. If you want to hear some of your colleagues talk about transactions they've done and good, bad, and ugly, you can go to Second Bite Podcast.
Awesome. So we will leave a link to Todd's website. We'll leave his email. We'll leave a link to the podcast in the show notes for you to check out. So just scroll on down if you're listening. And with that, Todd, thank you very much for making the time. I really enjoyed our chat.
It was great for me as well. Happy to be on the show.
Hey, thanks so much for tuning in to today's episode. I hope you enjoyed it. And if you've ever found yourself thinking, man, I get so much value from this podcast, I wish there was something I could do to return the favor. Well, today's your lucky day because you can leave us a review wherever you're listening to this, and it is incredibly helpful. Of course, if you haven't grabbed a free copy of the Agency Profit Toolkit, go and get that. It's got tons of free resources to help you improve your profitability. If you're looking to get in the fast lane and get help from experts to improve your profitability and measure your most important metrics, then apply for a consultation at Parakeeto.com. We'd love to chat with you and figure out how we can help. With all of that, thank you so much for being a listener, and we will see you on the next episode.